Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Salesforce, the sell-off is overdone. A contrarian buy opportunity. Rating upgrade. This article was written by Johnny Zhang, CFA. Summary. Pause. Salesforce's agentic AI business remains solid, but we don't see growth inflection, reflecting a small revenue mix and slower AI monetization.
Current bookings and CRPO remain double-digit momentum, and the 4Q FY 2026 organic growth is in line with prior quarters. Agentforce ARR grew 330% year-over-year to $540 million, but only accounts for 3.6% of FY 2026 subscription and support revenue. FCF has been growing strong, expecting a 31.9% year-over-year in 4Q FY 2026, driven by strong FCF margin expansion. The stock is trading below 52-week lows and flashing deep oversold signals, and the PCF is at a historical low. Why I'm upgrading to strong buy. I've been covering Salesforce Inc., CRM, for many years, and I've seen the company thrive through many acquisitions. I think it's totally fine as long as it generates synergies to accelerate growth. Last year, investors were excited about the future of agentic AI and discussed how it could potentially drive massive enterprise adoption. But today, they are not so sure. The stock is down 13% year-to-date as it suffered from a broad-based pullback across the software sector. This sector rotation reflects pessimism regarding AI software transition and profitability. When a sector is selling off, we should look for high-quality names with stable growth and solid FCF generation. I believe CRM can offer both, but market is discounting it because investors want to see strong acceleration in revenue growth. Agentforce and AI revenue are growing fast, but still very small. In my last analysis, I maintained a buy rating because of strong backlog growth, showing robust demand. At that time, the current bookings were expected to accelerate to 7.4% year-over-year from 6.5% year-over-year in 2Q. The actual result came in better, at 9.8% year-over-year. But why is sentiment still weak? Investors now are demanding higher total revenue growth and margin expansion, driven by Agentforce, which has not happened yet. While investors stay on the sidelines due to lack of growth inflection, this could create a bargain opportunity. Despite high single-digit revenue growth, total backlogs were still solid, showing resilient demand. After the sell-off, CRM has wiped out all gains since November 2025 and is trading below the 52-week low of $223. Meanwhile, the stock is deeply oversold, with RSI 14 currently at 25. Therefore, I'm upgrading CRM to strong buy, as its valuation multiples are getting more attractive. Agentic AI adoption is strong, but monetization takes time. Although the CEO Mark Benioff called Agentforce as the fastest-growing product ever in 3Q FY 2026, market largely shrugged off his comments because its FY 2026 subscription and support revenue guidance still points to a high single-digit, in line with the last year's momentum. Investors care more about the pace of agentic AI monetization rather than strong adoptions. Let's dig into CRM's feature product, Agentforce. First, during the recent earnings call, management disclosed that Agentforce has completed a total of 18,500 deals in 3Q FY 2026, up 48% compared to the previous quarter. 51% of them were paid transactions. We can see that this ratio hasn't picked up since the 1Q FY 2026. Based on the data from the past earnings calls, we can conclude that current strong adoptions in Agentforce haven't translated into stronger monetization. Second, as shown in the chart above, Agentforce and Data ARR achieved $1.4 billion in 3Q FY 2026, consistently maintaining triple-digit growth over the past several quarters. Agentforce ARR grew 330% year-over-year to $540 million in 3Q FY 2026. However, this revenue contribution is very small relative to the company's total revenue. For example, using the 10% year-over-year growth in subscription and support guidance for FY 2026, the segment revenue is expected to be $39.3 billion. So,
The $1.4 billion of Agentforce and Data ARR represents only 3.6% of FY 2026 subscription and support revenue. Therefore, despite the tremendous growth momentum, Agentforce still can't move the needle to drive growth inflection, even by FY 2027. This is a key reason why the stock sentiment is weak. Like other AI application software names, CRM has been discounted by the market since late 2025. Bookings and backlogs are still resilient. We should also look at some bright spots for CRM.
Overall demand is still solid, supported by consistent double-digit growth in total RPO.
This metric represents the total value of contract backlog that will be recognized as future revenue. In addition, current RPO, CRPO, refers to the near-term backlog normally within the next 12 months, which grew 11.4% year-over-year in 3Q FY 2026. We can see the growth momentum hasn't slowed yet. For incoming 4Q FY 2026, the company guided 15% year-over-year growth in CRPO, but includes a 400 BPS contribution from Informatica. By excluding this impact, the adjusted growth rate would be 11% year-over-year, in line with the current trend. We also can calculate CRM's total bookings by adding total revenue to the sequential difference of CRPOs. This implies an 11% year-over-year growth in 4Q FY 2026, showing acceleration from 9.8% year-over-year in 3Q.
Since these metrics reflect future revenue momentum, I believe CRM still can achieve double-digit revenue growth in FY 2027.
FCF growth and margin are improving. Don't forget, FCF is king, but market seems to be downplaying it. I believe CRM's robust FCF generation can enhance the stock's quality. Based on midpoint of 13.5% FCF growth for FY 2026, this implies a 32% year-over-year growth in 4Q FY 2026. The FCF margin is expected to jump to 44.9%, up from 38.2% a year ago. From FY 2023 to FY 2026, CRM would achieve a 30.8% compound annual growth rate in FCF. Therefore, CRM's fundamentals are still in good shape. The stock is trading at a historical low in terms of cash flow generation. CRM is down 35% from its 2025 high, crashing its valuation multiples. If CRM's fundamentals deteriorate, we would see more expensive forward multiples. While trading at 19x non-GAAP PE, FWD doesn't seem dirt cheap. PCF is trading at the historical low around 16.6x. On a forward basis, the multiple would come down to 15x, 27% below the sector average. Agentforce is growing fast, but it'll still take several years to meaningfully affect CRM's top-line growth. When you look at Seeking Alpha's earnings revisions page, growth momentum on forward revenue and EPS estimates is stable, not slowing.
Therefore, the recent sharp pullback is overdone, which creates a strong buying opportunity. If the AI monetization can come in earlier than expected, CRM...
Hey viewers, don't forget to like, subscribe, and add our channel to your favorites. We will continue to provide you with more insightful stock analysis.